Welcome to the next installment of my video lecture series for microeconomic principles. And in this particular video, I'm going to be taking a look at a homework problem from Chapter 19. I believe for this particular class, it is for the very first one, but for reference, it's Section 19.1, the Economics of Taxation. Text problem 2, algo, which just means it's an algorithmic problem. Each time you take it, it gives in, randomly selects the data that it's used. So let me just read through this. Using the tax brackets and rates from 2009, compute the total tax for each of the following. In each case, calculate average and marginal tax rates. Assume in each case that the taxpayer chooses the standard deduction. A single taxpayer earning $35,000 would pay taxes of what? With an average tax rate of, we're going to calculate that, and a marginal tax rate. I think the main thing that messed people up with this was the standard deduction. Standard deduction is subtracted off of your income, and it gives you your taxable income. So you take that $35,000 that the individual earned during the year, you subtract off the standard deduction of $9,350, and that leaves your taxable income. For this individual, it's $25,650. Now, the easy part of this is figuring out what the marginal tax rate is. All you need to do is plug in or take a look at where this taxable income falls for these income tax brackets. So if you take a look at here, you can see that you were taxed at 10% up to $8,350. So we are not in that tax bracket, so we will check the next tax bracket, which goes up from $8,351 to $33,950. So that dollar amount falls in there. So our tax bracket is 15%. That is the marginal tax for this individual. So all you need to do when you're calculating marginal tax rates is to take a look at what their taxable income is and find out what tax bracket they actually fall into, and what tax bracket they fall into is their marginal rate. Now what we need to do is actually calculate taxable income for each of the brackets and the taxes that are owed. So if we take a look at this, the first $8,350 is taxed at 10%. Since this person is making more than that, their taxable income is going to be the maximum amount for that bracket. So it's $8,350 that is going to be taxed at 10%. So we just multiply 10% by that column, and that gives us $835. So for their income up to $8,350, they are going to be taxed $835. It's 10% on that first $8,000. Now that we get to the next bracket, what you end up seeing is that this number is less than the upper threshold, which means they are not going to pay the full amount that's in this bracket. They're going to pay the difference between the $8,350 that's already been calculated as taxable income and subtract it off of that number. Okay, so if you take the $25,650, subtract off the $8,350 that's already been accounted for, that gives you the leftover amount that falls into this bracket, and that is equal to $17,300. And the way I always tell students to check this out is to add these two numbers together. If you add these two numbers together, you get $25,650, which brings you back to your original taxable income. All right, so make sure you do that once you determine what your marginal tax bracket is, when you figure out what these individual increments that are taxable in each bracket, you get to the marginal tax bracket, that's your last one, and then add up those numbers to make sure you get back to the original taxable income number. So this $17,300 is going to be taxed at 15%. I've already got this in that formula, so I just calculate that down or translate that down or copy it down. So that tells me for this $1,730 in this bracket, this person is going to be taxed at $2,595. So in order to get their total tax paid, you just add up those two numbers, and that gives you a total tax of $3,430. $3,430. Now, to get the average tax rate, you just take the total tax that the individual paid across all those brackets and divide by their original income number. So if we were to take the $3,430 and divide by the original income of $35,000, that will give us the 0.98 or 9.8%. So I think what most people ended up having issues with here, and let me actually put this number here, 9.8%. That the issue most people had is they forgot to subtract the standard deduction off of people's income to get taxable income. And then I think individuals had difficulty in assigning taxable income into each of these tax brackets. For that, just make sure you take your taxable income. You see here that the first bracket is $8,350. Since that number is in excess of that, all $8,350 is going to be taxed at 10%. So it's $8,350 multiplied by 10, $835. We move down, which we get into our marginal tax bracket. Our marginal tax is 15%. This is the final tax bracket that the individual falls into. In order to calculate that, we see that with our $25,650 is less than that upper bound number. So we know we're only going to have a portion of income taxed at 15%, not all the way up to $33,950. So what we do is we take our taxable income and subtract the taxable income from that we've already had taxed, and that leaves us with $17,300. And we can stop there because we've already reached the threshold. This is our marginal tax bracket. Our taxable income is less than this upper threshold, so we don't have to do any more calculations because the income is not high enough. To get the total amount here, you just add up the amount that's paid in each of the individual brackets. And then to get the average tax rate, you take the total tax paid, divide by people's original income, and that gives you the margin, that gives you the average tax rate. The next one is a little more difficult because income is higher, so we have to move through more and more brackets. So we have the same exact question. The only thing that has changed is this person's making $110,000. So if we want to take a look at this, we want to find out the marginal tax rate. We take a look and see where $110,000. I'm sorry. We need to find out what taxable income is. So we take the $110,000. Again, we subtract off the standard deduction. So this person has taxable income of $100,650. So we take a look at that number and see where it falls. It's greater than that upper bound. It's greater than that upper bound. It's greater than $82,250. It falls in this range here. So this individual faces a marginal tax rate of 28%. All right. Their taxable income is $100,650, which falls between this range here. So that tells us their marginal tax rate is 28%. What we do is we go through and calculate all of these based upon the numbers here. So we know that $100,650 is greater than $8,350. So their amount taxable in that particular bracket is $8,350. And they're taxed at 10%, so I can put 10% multiplied by the taxable income in that bracket, $830. We take a look at this taxable income of $800,650. We go to the next bracket and we see that exceeds the upper bound, so they're only going to have to pay a portion of that at 15%. So what I do is I take off that $8,350 off of the $33,950. So if I subtract $8,350 from $33,950, I end up getting $25,600. And let me put the comma in there to make it consistent. Again, if you want to check to make sure that's right, just add these two numbers together. If you add 8,350 together with 25,600 together, you will get the upper bound bracket here of 33,950. So this 25,600 is going to be taxed at 15%. I can just copy that formula down. So they are going to pay $3,840 on that next $25,600 in that particular bracket. So we keep going. We see that we have taxable income of $100,650, which is greater than this $82,250. So what we end up doing is we subtract this $33,950 off of $82,250, and that gives us $48,300. All right. So if we went through and added all these together, we would get that upper bound bracket there. So they're going to be taxed at $48,300 at 25%. I can copy that formula. So if I take $48,300 and multiply by 20%, that tells me how much they have to pay in that bracket. So they have to pay $12,075. And in this final bracket, we can see that this $100,065 does not hit that upper bound. So now we have to figure out how much money is actually taxable in this range. We've already taxed them up to $82,250, so we could subtract that off of the $100,065, which would give us $18,400 that would be taxable in that bracket. And if we multiply that by 28%, that gives us $5,152. We add all those together. That's the sum. And that gives us $21,902 for the total income that is spent. And if we want to get, and that's total taxes of $21,902. And for the average tax rate, you just take the total taxes that were paid across all the brackets and divide by the original income that we had prior to the standard deduction. So we take that 21,902, divide by the 110,000, and that gives us a average tax rate of 19.91%. So I think in just closing, a couple of things that people made the mistake doing this were they forgot to include the standard deduction. They forgot to subtract off the $9,350 off of people's total income to get taxable income. Then I think some people struggled with how to determine how much money was in each bracket. All right, remember for the marginal tax rate, you just take a look at what your taxable income is and find out what income bracket it falls into. In our case, it falls in here. That means the marginal tax rate is equal to 28%. Then you need to figure out how much taxable income falls in each bracket. For the brackets before the marginal tax rate, it's going to be the maximum amounts. So for the 10% one, it's going to be the upper threshold. For the 15%, you subtract off that upper threshold from this upper threshold to give you the amount of money that falls in this bracket. And you keep doing that until you get to the final bracket. And then when you get to the final bracket, you only take into account the money that falls into that bracket. So you take into account that you've already, for example, if you're at the 28% bracket, you've already been taxed on $82,250. You subtract that off your taxable income, and that tells you how much money falls in that final tax bracket.